The presidential debate has finally got the attention of the financial markets to US election risk. So where do those risks lie and where might they spread to? With me to discuss this is Michael Metcalfe, Head of Macro Strategy at State Street Global Markets. Michael, what was the impact of the election debate on the markets?
Well, we've seen significant volatility, particularly in the Mexican peso. And that seems to be where the market is coalescing around, using that as a vehicle now to price in US election risk and volatility.
And what other currencies have shifted?
Well, a little bit of an unwind of safe havens. So the Japanese yen, which had been gaining in the run-up, has sold off as well. And obviously there's a backwash from the Bank of Japan there as well. So it's been a little bit about risk on, but particularly the Mexican peso.
So do you think the market is now got its sights on the US election? Let's look at the first chart, which can compare the extent to which the market is preparing for the US election to how the market was ready for Brexit.
Yes, and so, I think when we look back at Brexit with hindsight, perhaps the market that priced it most efficiently and earliest was the FX options market, which showed a very significant skew towards sterling weakness. And so you can see the red line here looks at the skew in the FX options market ahead of the Brexit vote and the skew towards sterling weakness. And so, the premium for sterling puts, you can see, where are we? About 30 days ahead of Brexit was about 4 times. It was 4 times more likely to go down.
Some way to go still for the Mexican peso.
Yeah, and so the Mexican peso. Now, the interesting thing, Mexican peso obviously is a more volatile currency anyway. It's a high yield currency. So this skew generally should be higher than sterling. And right now, yes, it is high. And we have seen significant volatility in the Mexican peso. The currency was at a record low before the debate. But the Brexit skew in sterling shows just how much further that could go.
Okay, and let's just remind ourselves why we're talking about the Mexican peso. Obviously, it's the effect of what Donald Trump has been saying on trade, which is having this effect. And it's not just the Mexican peso. Our second chart suggested it might be China, one of the US biggest trading partners, that could suffer.
China is interesting because he's talked about labeling China a currency manipulator. And markets have been very focused on how far the Chinese authorities will allow their currency to weaken, in fact. And so, if there's a rising chance of a Trump presidency, there's a risk that before that, the Chinese allow their currency to weaken a little bit further. And for us, fair value for the Chinese currency against the dollar is above 7. And so, it's actually still 6 or 7% overvalued.
Okay, and clearly Trump has implications across various other markets, particularly emerging markets. And our third chart is about the impact of Trump across that region. What do you think is likely to be that impact?
Well, I think one of the big concerns right now, and actually you could lump Brexit in this as well, is this concern about growth in global trade. And obviously many of the things that Trump is talking about are potential negatives for global trade. And you can see here that global trade volumes, actually, their starting point is quite weak. So on a year-over-year basis, global trade volumes are in fact negative. Now, okay, they're not as bad as they were in the financial crisis, but they are falling. Global growth, as we know, is weak. Now, capital flows into emerging markets, which obviously have been a very important trend in the last few years, can be very cyclical. We saw in the crisis they fell with global growth. But more recently, in fact, they've been very negative up until about 6 months ago when the demand for yield returned. And so I think the big question now is that emerging markets face this dilemma where they're receiving a lot of capital into their bond markets because there's yield there, but will slowing growth disrupt that? And at the moment, at least, it suggests not. So demand for EMs, local sovereign debt, is still very, very strong.
Okay. This is all predicated on the idea that Donald Trump is going to win the presidency. And the extent to which we've seen a relief rally following the debate for those in the market who have been worried about a Donald Trump presidency is one of the main outcomes of today. What do you think that's going to happen to that relief rally? Is it going to come up and down? Is it going to be very headline driven? Is it going to depend on how the polls react?
Yes and no. So yes, we're clearer because I think finally the market's begun to discount volatility around the event date, which it was surprising us actually that it wasn't doing that earlier. It was much earlier, in fact, in Brexit. And the no part is that we still have 6 weeks to go. The polls are still suggesting this will be a very close race. exactly like they did with Brexit. And so while the betting markets might say one thing, the polls are very clearly suggesting that the market is right to continue to price in uncertainty. And so, I think premium for volatility around the election date will remain pretty high unless the polls show clearly in favour of one candidate or another.
2 debates to go, lots of polls still to come. Michael Metcalfe, thank you very much.
Pleasure.
The first of this year's US presidential TV debates triggered a frenetic morning in Tokyo's currency dealing floors as traders used global forex markets to place their bets on Donald Trump's temper and Hillary Clinton's stamina.